Okay, just quickly on the China issue, the takeaway for many people, overwhelmingly the consensus view, is that so long as this tension does not bleed into trade, it doesn't matter to us in financial markets. Is that a bad take?
You know, I think each incremental move and kind of decoupling between the U.S. and China is hard to really price into markets. But one thing we know for certain, and I know some of your previous guests and Michael was just mentioning a moment ago, is that we have moved from a period of strategic cooperation with China to a period of significant, strategic competition. And that's on every front. It's around technology, it's around cyber, it's around access to the virus, remedies, whether that's a therapeutic or a vaccine. And we expect this decoupling to accelerate over coming years, regardless of which party takes control of the White House and overall D.C. in January of 2021. So what do markets do about that? I think that there are still opportunities to invest specifically in Chinese domestic plays that are less, perhaps sensitive to some of the trade issues and that are really geared towards the Chinese consumer, which is still putting up really good numbers. But we have to be thoughtful about the companies that rely on huge amounts of sales from China, whether or not they, reshore their supply chains or reduce their exposure to that market. So this is something analysts are going to be watching very closely.
Okay, we often talk about risk around this story. Let's talk about opportunity. There is a belief that the world breaks into two spheres of influence, with China and the United States at the epicenter of either. China quite clearly is choosing national tech champions. Is there an opportunity there for a foreign investor?
Look, I don't want to sound a little Pollyanna here, but yes, there's absolutely opportunity for global investors. As we separate supply chains around 5G and around technology, we're going to see both in the U.S. and in China, smaller companies, parts of the supply chain, components manufacturers, service providers, actually grow in size and import for the specific end market that they're serving. So, and in my view, there's two ways to kind of approach this. You can say, I'm not going to touch anything in China, or you can take advantage of this decoupling and invest in parallel technology systems in the U.S. and in China.
Kate, the additional story, the structurally impaired constituents that you think we should avoid right now off the back of this pandemic. Can you walk us through that and why you think that's the biggest concern, the biggest reason why you don't expect a big value rebound?
Yeah, every time we have a small rotation in the market, you see more domestically oriented plays, some of the small and mid caps do well. Stuff that falls into deeper value, perform, especially relative to the high-flying tech companies. Everyone is calling for a significant value rotation. But John, you and I both know that in order for value, as it has traditionally been characterized, to significantly and persistently outperform, you need a big acceleration in the economic activity. And we're just not expecting that in the near term. I mentioned a couple of times that I think the economic path is going to be quite uneven. And I actually think that some of the stuff that falls into the value bucket is structurally impaired. There are parts of the resource sectors, in particular energy, that don't look very attractive to us. And there are parts of stuff that is very well owned, that is trading at premium multiples in technology and in consumer, that we think deserves those multiples. Because even in a weaker economic environment, these companies are putting up revenue growth. And that is a critical component, I think, when we're looking for quality and sustainability.
So, Kate, I respect that you can't do single names, but give us the playbook, the guidebook for identifying the value traps and the value opportunities.
Yeah, I think as we've thought about opportunities in cyclicals and in things that are priced at a discount, let's say, to the technology and consumer names, we want to stay in higher quality companies. We've called that sometimes wimpy cyclicals, but we do have exposure to parts of the industrial complex and some selected parts of resources globally that we think will do well. But as I was mentioning, energy is a place we just don't want to take additional risk. And I think you have to be selective around the banks. Financials play a part in value indices and into some of this sort of rotation trade. But I would say, in that space, we want to own the higher quality banks that have the greatest exposure to the higher quality consumers and the lowest probability of taking on huge amounts of credit loss.
Okay, there's something we keep coming back to, and this conversation keeps taking me there. It's something you've said repeatedly, that the composition of this recovery is more important than the shape of this recovery. Why is that the case, Kate?
Because, what we've seen with the pandemic and the sort of response to COVID-19 has been an acceleration, or a word that I keep using, maybe it's a little bit nerdy, supercharging of existing trends. And that's around how we consume, how we spend money, how we spend our time, what services are priorities for us. And many of these trends were in place at the end of 2019 in January, February, but we have sort of shifted both on a corporate and a consumer level to really focus on the most efficient means to consume both products and services. And I think this environment is giving us an opportunity to put even more money behind those companies that provide those products and services. So it's not so much that we're going to go back to the previous 2019 economy or 2018 economy, but the compositional change, I think, is where we're seeing the greatest opportunities. And again, a lot of that's around tech, parts of the consumer, just-in-time delivery, and services that meet our new, at least for now, work from home, and in the future, partially remote working environment.